Welcome to vTalkInsight, Risk Sentiment Daily for April 9th, 2026. A last-minute ceasefire between the United States and Iran has unleashed one of the sharpest relief rallies since this conflict began, with equities surging and oil tumbling. The key issue now is how durable this risk-on turn really is, given the deep energy and credit fragilities that still sit just below the surface. Risk sentiment has swung clearly into risk-on territory, but it looks fragile rather than euphoric. Global equities have posted outsized gains, with the S&P 500 jumping around 2.5% and major European indices rising by about 5% as investors price out the most extreme Middle East energy shock scenarios. The ceasefire and partial reopening of Gulf shipping lanes have driven some of the largest oil price declines since the pandemic, sharply reducing the immediate geopolitical risk premium. That pullback in energy prices is easing near-term inflation and growth fears, supporting a broad rally across cyclicals, small caps, and travel-related stocks, while volatility indices retreat from recent highs. Under the surface, though, this looks more like a flow-driven squeeze than a full-throated risk reset. Hedge funds and systematic strategies are covering shorts at the fastest pace since 2020, yet active managers remain cautious, and some benchmarks still show below-average conviction buying. With the ceasefire window only 2 weeks long and energy and credit risks unresolved, today's risk-on stance comes with a clear warning label. The biggest bullish catalyst today is the ceasefire and energy price relief. A temporary 2-week truce and safe passage arrangement in the Strait of Hormuz have triggered double-digit declines in Brent and West Texas crude, with some contracts falling more than 15% in a single session, the steepest drop in years. This collapse in the risk premium is rippling quickly through equities. European benchmarks are staging a rare 5% style relief rally. Airline stocks are rebounding sharply on expectations of lower jet fuel costs, and travel names are reversing prior underperformance. At the same time, upstream energy majors such as BP and Shell are down 7 to 8%, underlining how sharply leadership has rotated away from producers toward energy consumers. The relief is meaningful, but the runway is short. The ceasefire lasts only 2 weeks. Iran still controls transit and fees through Hormuz, and hundreds of vessels remain stranded as shipowners wait to see how safe the corridor really is. Markets are treating this as a window to move as much oil as possible, not a return to pre-conflict normal, so energy price volatility is likely to stay elevated even if the direction, for now, favors risk assets. The second key bullish driver is central bank pivot and disinflation hopes. As oil retreats from recent triple-digit peaks, bond markets are quickly repricing inflation risk. 2-year and 10-year Treasury yields have rolled over, and European government bonds have rallied hard, with Italian 10-year yields dropping by more than 30 basis points. This move in yields reflects a rapid shift in policy expectations. Markets are stripping out previously priced European central bank hikes and reviving the idea that the Federal Reserve could pivot toward rate cuts later in the year if energy-driven inflation pressures keep fading. In Europe, current energy pricing is described as broadly consistent with the central bank's baseline, reinforcing the case for a pause rather than renewed tightening. That said, the higher-for-longer narrative has not vanished. Several assessments still argue that structurally higher energy costs will keep headline inflation elevated into the summer, limiting the Fed's room to ease and leaving some investors expecting only 1 or 2 cuts at most. For multi-asset portfolios, this means today's friendlier rates backdrop is supportive, but still contingent on energy prices not re-accelerating from here. A third supportive force is that positioning and short covering fuel rally dynamics. Ahead of the ceasefire, hedging across equities, credit, bonds, and oil had reached extremes not seen since the Gulf War, and institutional investors had cut risk to levels comparable with prior major geopolitical shocks. The ceasefire flipped that setup. Hedge funds are now covering equity shorts at the fastest pace since 2020, helping to drive a broad-based rally where small caps and big technology names are both up more than 3%. In Europe, more than 500 stocks in the Stoxx 600 are advancing, with trading activity running at well over 1.5 times normal levels, signaling large-scale repositioning. Systematic strategies may add further fuel if key index levels are breached, with some estimates pointing to as much as $200 billion of potential mechanical buying. Yet several observers stress that these flows are largely technical rather than driven by upgrades to the macro outlook, which means the same positioning could reverse quickly if geopolitical headlines deteriorate or data disappoints. On the bearish side, persistent energy shock and supply disruptions are a major counterweight. Even after the price drop, the physical oil market remains extremely tight. Global inventories have been run down aggressively. More than 800 vessels are still backed up in and around the Persian Gulf, and over 400 tankers, including liquefied petroleum gas and liquefied natural gas carriers, remain stranded near Hormuz. Infrastructure damage compounds the problem. Key Gulf refineries are only partially operational. Qatar's liquefied natural gas export capacity has been set back by years, and refiners in Asia, especially in China, Korea, India, and Singapore, are already experiencing acute crude shortages with no easy substitutes. This has produced extreme backwardation, where spot crude and products have recently traded far above deferred contracts, and has pushed jet fuel prices in places like the U.S. West Coast well ahead of global averages. The macro implications are significant. Demand destruction of roughly 1 million barrels a day is already visible in Asia, and there is an estimated 2.5-month lag before these higher energy costs fully hit Western economies. The International Monetary Fund is preparing to cut its global growth forecast on the back of this supply shock. That suggests the world may still face a lingering growth and inflation hit, even if headline oil prices have just experienced a dramatic pullback. The second key bearish driver is private credit stress and liquidity crunch. Large private credit funds are seeing redemption requests far above industry norms, with examples such as Blue Oak Capital's Income Fund and Blue Owl's flagship vehicle facing negative outlooks as investors seek to exit illiquid structures. These outflows are raising concerns that risks in private credit could spill over more broadly. Conventional banks have lent heavily to non-bank financial institutions, and there are worries about practices like multiple pledging of collateral. Recent declines in Treasury yields have been partly attributed to anxiety around these vulnerabilities, as investors move toward the most liquid safe assets during periods of stress. So far, this is seen as a serious, but not yet systemic problem, with no immediate expectation of a full-scale collapse in private credit. Public credit spreads remain relatively contained, and liquidity in electronic rates markets is robust even as credit trading stays more cautious. Nonetheless, for risk sentiment, this remains a key pressure point that could reintroduce risk-off moves quickly if macro conditions deteriorate or redemptions accelerate. The third bearish force is stagflation risk and policy constraints. Despite the latest oil pullback, several assessments still see Brent and West Texas crude settling in the 80s, well above pre-conflict norms. That backdrop, together with earlier surges in physical prices, is expected to keep inflation pressures elevated in coming months and may encourage the Federal Reserve to maintain its current stance for longer. At the same time, governments are ramping up defense and energy resilience spending, exacerbating fiscal deficits. Central banks in countries such as China, India, and Turkey are adding to their gold reserves as geopolitical insurance, signaling distrust of traditional safe assets. History during periods of rising stagflation risk shows that cross-asset correlations can move strongly positive, with equities, gold, emerging markets, and even longer duration bonds all falling together, leaving cash and the dollar as the main refuges. Corporate fundamentals could also limit how far risk-on can run. Some analysts argue that earnings expectations, particularly in Europe, look too optimistic, with actual growth likely closer to mid-single digits than current forecasts imply. Others highlight ongoing upgrades to U.S. and global profit estimates, especially in technology and travel, which provide an offset. Taken together, this leaves a macro picture where upside remains, but the distribution of outcomes is wide and still skewed by inflation and policy uncertainty. To sum up, today's backdrop is a fragile risk-on. The U.S., Iran ceasefire, and sharp energy price relief, together with lower yields and powerful positioning flows, have driven an impressive cross-asset rebound. Offsetting that, the underlying energy shock, private credit strains, and a stubborn stagflation risk mean the medium-term picture is far from resolved. For portfolios, the focus now turns to how quickly Gulf shipping normalizes, how central banks respond to the new inflation path, and whether credit and funding markets stay orderly as volatility in commodities and rates persists. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.